Audience. Well, welcome everybody. It's May 27th, 2025, and I'm here with William Pesek. William joined us recently. As you know, Eric spent about a year with us. I gave him, he's my Manchurian candidate. Eric was at the Wall Street Journal, joined us for a year. I thought he'd stay longer than that, but he got a great offer at the Council of Economic Advisors. And as I told you last week, he got a great title, Senior Advisor to the Chair of the Council of Economic Advisors. So that, I guess, means that Eric is only 1 degree of separation away from the president, which means that I'm only 2 degrees away from the president, since I guess I can email Eric and give him some thoughts about what they're doing. I'm sure he won't respond as is required by keeping everything a tight ship on his end. But anyways, I wanted to welcome William. William is in Tokyo. I half jokingly say that he's the chief of our Tokyo bureau. I guess chief with no Indians. But William, thanks for joining us. William's got years of experience monitoring the global financial economy and global financial markets, and you've settled down in Asia, and you've done a lot of work on Asia, which I think is turning out to be a great opportunity for your Ardeni research to have your talent right there in the middle of Asia. You wrote a book on Japan, correct?
I did 10 years ago now, but yes, hopefully more than my parents have read it.
Right. And you've traveled around the Asian region?
I have very extensively.
Good. All right. So the idea is William will, from time to time, focus on Asian issues when they're relevant, but William has extensive background in analyzing the U.S., the Fed, and so he'll be part of our team. And whatever our team does, William will do, and certainly on the Asia side, he'll make a huge contribution. And we've already seen that the past couple of weeks, William wrote a couple of very insightful pieces on China, and then this morning in Tuesday's morning briefing, wrote one on Japan. So we'll get into that in a minute, William. I just want to share with everybody some charts here for a second for data that just happened to come out. And it's a consumer confidence survey. And as we've often said, when consumers are happy, they spend money. And when American consumers are depressed, sometimes they spend even more money as long as they have jobs. So the key issue is what's going on in the labor market. And there are 2 surveys of consumer optimism. One is called the Consumer Sentiment Index, which I don't particularly like. It tends to be very pessimistic. I have nothing against pessimists, but on the other hand, I do tend to be an optimist. But the Consumer Sentiment Index seems to be very sensitive to inflation, and seems to be more sensitive to inflation than ever, because the Consumer Sentiment Index used to be highly correlated with the price of gasoline, and now we've seen expected inflation go up to 7% and having no relationship whatsoever with gasoline. It seems to have turned very partisan, very Democrat versus Republican, with extreme views reflected on both sides. And Republicans are probably happy, but not exuberantly so, whereas Democrats are depressed and extremely so. That I think would explain why the CSI has been so negative. On the more balanced side, we like to use the Consumer Confidence Survey, and it tends to be more reflective of what's going on in the labor market, which is obviously particularly relevant to the issues that we're confronting in the market. So let's just skip here. This is just automatically updated charts that appear on our websites. You can always go there when the releases come out and look to see what's going on. But as you can see, we had a a very nice rebound in the consumer confidence index. This is in May, so you have that over here. You can see the expectations component, which had been extremely depressed, is less depressed. It is still depressed, but less depressed. So people are still concerned about the future, but less so. And meanwhile, the present situation's kind of hanging in there at a pretty decent level. And the reason for that is because the labor market seems to be doing relatively well. So we're big fans of this data because the data that you're seeing here is one of the kind of first takes we have on the labor market, looking into May, anyways. And soon we'll be, I guess, in the beginning of June, we'll be getting May data on payroll employment. But here, this is an indication that the labor market stayed fairly robust right through May. And all this tariff turmoil unleashed by President Trump occurred basically in March, April, and May. And yet, despite all that, we're seeing that the confidence has held up, or at least rebounded. But most importantly, is the labor market indicators. This is jobs plentiful, still relatively high, and jobs hard to get, still relatively low, picking up a little bit. But this tends to be correlated with initial unemployment claims, and initial unemployment claims certainly suggest that there's nothing to worry about through the latest weekly data with regards to the labor market. Looking a little bit at the expectations component, this is consumer confidence jobs in 6 months, and you can see that the red line is the same amount of jobs has actually been deteriorating. So there is worry about the job situation, but the current situation remains very robust, as I just showed you. There's some other indicators you can look at along the way here. This is consumer confidence survey, stock prices lower in 12 months, and you can see that the lower took a huge jump here, which from a contrarian standpoint is bullish, and it has been bullish as we've seen with this V-shaped recovery in the stock market, and now they're still relatively bearish, which is good for the market from a contrarian perspective. That's kind of what I wanted to discuss there. This is just another slice and dice. This is the jobs plentiful. This is jobs hard to get, and this is jobs of plain available. So that's that one. And then here's the present situation component of the consumer sentiment index. As you can see, is very highly correlated. Tracks, as a matter of fact, the jobs plentiful minus the jobs hard to get. So so far so good. We've been in the no recession camp for a while. Obviously, in March, with what was going on with tariff turmoil, we raised the odds of a recession, but we didn't go to the cross over to the dark side. We never went above 50% in our forecast. And once Trump started backing off on his, at least provided some postponement of his tariffs, then we started lowering our odds of a recession. So let's go back to the full screen here. William, give us a little bit of a summary of the morning briefing today. It's a fascinating story, obviously, because Americans tend to be very U.S. centric. We do obviously have a global perspective, but if we're often clueless about what's going on in our credit markets here, as we saw back in 2008, 2009, I guess we have the risk of being even more clueless about other capital markets. Does Japan's capital market really matter to us, and should we be worried about the recent sharp increase in bond yields? And William, after you give us the summary, I will take a little share of the slides to look at the charts that are included in the morning briefing.
Sure. Yeah, it's been a very interesting couple of weeks here in Japan. A very interesting 7 days, especially. As we all have read recently, there's been There was this rather dismal bond auction roughly 8 days ago, and the global economy has not really been the same since. As Ed was saying, it is true that Japan's debt markets don't typically matter a great deal to investors around the world, but there's a couple of reasons why Japan really does matter at this point. One, it's the third biggest economy in the world. The other thing too, Japan is the world's biggest creditor nation. Germany is gaining, but Japan's the biggest creditor nation, and the yen carry trade is kind of the oxygen that hedge funds operate on. And so anytime you see events in Japan zig, markets everywhere zag. I mean, the yen carry trade has been used to invest on Wall Street. People buy New Zealand debt with it. They buy Indian property. They buy Thai stocks. Whenever the yen gyrates, it affects markets around the world. And whenever people talk about the yen carry trade blowing up, there's a lot of hedge funds around the world that begin to worry about their survival. And so, as I wrote this morning, what's happening in Japan's bond market is largely a product of what's happening in the US, right? You've had this Trump tariff tantrum in the Treasury market, which has in many ways reverberated back here to Japan. But domestically, you're also seeing the Bank of Japan trying to withdraw from the markets. The Bank of Japan has been trying to basically reduce their holdings of Japanese government bonds by nearly basically about $3 billion every quarter. And that's been going pretty well for the most part. But now that you have this Trump tantrum, it's kind of thrown kind of a spanner in the works. And the Bank of Japan has been trying to normalize interest rates for 2 years now and doing pretty well with it. But now that's been shelved for the most part because the Bank of Japan is worried about raising interest rates. And this kind of spasm that we're seeing in the Japanese debt market, we've seen some of this before, right? You've seen a variety of hedge fund managers over the years shorting the Japanese government bond market. You saw Kyle, I'm trying to think of his name.
Kyle Bass?
Yes,
Kyle Bass?
Kyle Bass. He was shorting the JGB market back in, say, 2012. David Einhorn was shorting the JGB market before that. And you've seen some shorting going on in the JGB market in 2022. It typically is the world's, ultimate widowmaker trade, right? You don't make a lot of money betting against the JGB market, perhaps until now. And again, as I was writing this morning, this is a moment where we do have to focus on what is happening in Japan. It's a concern for global markets. I think people are getting a little too negative about this being an Armageddon moment for the global financial system. You did see JGBs rally today because there is some optimism that the BOJ will take steps to increase liquidity. There's been some optimism that maybe the Ministry of Finance will throttle back a bit with debt issuance. And so, policymakers in Japan are very, very good in a crisis. And I think you've seen in the last 24 hours the extent to which they've been able to calm nerves in the market. That said, a lot of this is really contingent upon what happens in Washington. And if we do see Donald Trump, step back in the direction of aggressive tariffs, we could see more turmoil in the Japanese debt market. So I guess, the short answer for Japan at the moment is stay tuned.
But if the president continues to blink and to postpone and at some point declares victory, which is just something we've been arguing, there's sort of a clock on this thing, and that is that there's the midterm elections. I don't think the president wants to see the Republic. I mean, clearly he doesn't want to see the Republicans lose their thin majorities in Congress, and obviously the preference would be to increase the majorities, but to lose them would be a disaster, I would think, especially since some Democrats are already threatening that if they get back into a majority status, that they'll be investigating his entire family. So there's,
Right.
And of course he's also said a couple of times that he'd probably be impeached again. So he really can't afford to take a chance that if this thing lasts past the summer, that it causes a recession and which lingers into next year. That wouldn't be good. And then, of course, there's court cases that are coming up where he might lose, and the courts might rule that he doesn't really have the constitutional power to basically invent a crisis. I mean, nobody really believes that there's a crisis out there that requires the kind of actions that have been occurring on the tariff side. So I think one way or the other, he needs to declare victory. So let's say he does that, and that the Bank of Japan, the finance ministry, do whatever they need to do to calm things down on that end. Um, then Japan doesn't matter again. And it's kind of like, remember the carry trade? What was that kind of blew up for a day or
Right.
two, and
Right.
it didn't linger. It didn't last very long, and it was a
Sure.
buying opportunity. So you got people like Albert Edwards, who's always negative, but seeing Armageddon. I think he used the word Armageddon or
He
something.
did. He did.
Yeah, I'm not surprised by that, but from a contrarian perspective, he does tend to be particularly pessimistic when things turn around, and I think that's because when things get really pessimistic, you get a policy response. You get
Right.
a fiscal put, a monetary put here, there, wherever. So in that kind of scenario, is there still a situation where things are coming to a head in Japan? I mean, do these life insurance companies own a ton of these JGBs and they're getting slaughtered on them, or what's the deal?
Well, that's part of what I was arguing also on the piece this morning. I mean, your points are very well taken, and I do hope you're right about Trump being reined or hemmed in to some extent by political reality. But I think one of the reasons why the Japanese debt market is not about to collapse is what I call the mutually assured destruction dynamic. And that is that JGBs are the main financial asset held by pretty much every company and everyone. So if if yields were to surge, everyone essentially gets hurt. And so there's not a lot of incentive for domestic interests to sell JGBs aggressively. And JGBs are held by, about 88% of JGBs are held domestically. So there's not a great deal of risk of capital flight. And so in many ways, you do have this steady natural demand, which stabilizes the market to some extent. I think your point about the tariffs, the stock market, the bond market would probably become a side issue at that point. But then we're left with Japan's recession, right? I mean, Japan's economy contracted 0.7% in the first quarter. That was before the worst of the tariffs. The current quarter is going to experience the brunt of the tariffs. I know that Trump has throttled back tariffs on China from 145 to 30%. But 30% is still no joke for an economy of China's scale and with China's pre-existing conditions. I mean, China has deflation. It has a very serious property crisis on its hands, and that's bad news for Japan. And the other thing, too, is Japan, if it does fall into a deep recession, well, even a moderate recession, I think the policy tools are a problem, right? The BOJ doesn't really want to be cutting interest rates because they spent the last 2 years trying to normalize rates. Japan also has 3.6% inflation. So Japan is a better candidate for stagflation than the US is.
Right.
And on the fiscal side, if the government were to spend a lot of money on stimulus, which they have to borrow money to pay for that stimulus, then the bond vigilantes, as you know very well, Ed, might come back in this direction and make life difficult. So even if the bond market here does take a back seat in terms of the news cycle, the economy here is in for a rough time. And Prime Minister Ishiba is focusing or he's contesting an election 2 months from now. So you can argue that this is all coming to a head at the worst possible moment for Japan's political
For Japan.
establishment. Yeah,
Yeah,
not for the world, but for Japan.
yeah, which could have global implications, but then again, maybe not. Maybe not. Let's go to the charts here. If I can find where I put them. Okay, here they go. So I'll show the charts and I'll kind of ask you to just comment on some questions here. So I mean, figure one looks mighty spooky. Do we really care about the 30 and the 40-year bond yield? I mean, the 10-year, because I mean, it's up a lot. And the other question is, there's obviously huge capital losses involved in all this, but to the life insurance companies, as long as they hold it to maturity, they don't have to.
Exactly.
Yeah, it's just like here. So in other words, they're not going to be selling what they own. They're kind of locked into them, correct?
Right, exactly. So as long as they basically a critical mass of those holding GGBs hold to maturity, then it's not a very big problem. But you're right. I mean, there's a lot of paper losses going on. But then again, Japan is, because it's been going through this balance sheet recession on and off for the last 30 years, as
Yeah.
Richard Koo would talk about. Japan certainly understands a lot about paper losses, but you're right. I mean, these are unrealized losses. But I mean, I think usually in Japan, even here, we don't really talk much about the 30 and 40-year bonds ever. It's just become an issue in the last 10 days because of the turmoil in the treasury market, because of a couple of bad auctions. There's an auction tomorrow of 40-year bonds. And if that goes, if that comes and goes without a lot of fanfare, I think things will stabilize in Japan. If that auction receives, the very, very, if the bid to cover ratio is a disaster the way it was for the 20-year, it could be an issue. But you're right. The really important rate is the 10-year, and the 10-year is still 1.5%.
Yeah. And yeah, I mean, again, based on our experience with 2008, 2009, what bites you is something that you never really appreciated was out there, right? All those credit derivatives weren't fully understood and all that. And so I think the concern is that there's all kinds of cockamamie derivative products and carry trades and basis trades that could blow up here. But so far the evidence is that the carry trade blew up and it did it for 2 days, and then the basis trade in the U.S. blew up basically for a day, and so it does look as though the global capital markets and foreign exchange markets are actually pretty resilient. They can take these shocks without going into a meltdown mode, and I think that's partly because the central bankers are pretty skilled at coming up with emergency liquidity facilities. So, I mean, if you knew if we knowing what we know about the U.S. Deficit outlook, why isn't the bond yield at 5-6%? And the answer is, well, it got to 5% in 2023, and the Treasury demonstrated that they could bring that yield right back down by issuing more bills and fewer bonds and notes. So, the bond vigilantes are not the only game in town, not the only players in the game. Okay, let's look at this one. This is sort of the great QE experience right here. 2013, I guess it started. And tell us a little bit about this period. We had the QE, and then is there an official point at which QT started?
Well, so I mean, QE has technically been around since 2001. That's when the BOJ pioneered it. But in 2013, that's when QE was really turbocharged. That's when, at the time, Prime Minister Abe hired Haruhiko Kuroda to push the BOJ into uncharted territory. And that's when QE really began to, in many ways, gain traction in Japan. QT is something that's begun over the last basically 18 months, right? I mean, so basically, Governor Ueda stepped into the job in April of 2023, and he within 6 months began fairly aggressive, quantitative tightening, and that's where we are today. And I think one of the questions for the BOJ right now, given what's happening with the bond vigilantes, is the extent to which it maintains that quantitative tightening. And my gut feeling is that Ueda will. I mean, Ueda went to MIT. He studied under Stanley Fischer. He studied under the same professors as Ben Bernanke and Larry Summers and Mervyn King and Mario Draghi. And so basically, I think Ueda has proven to be a fairly interesting and solid presence at the BOJ, and I have reasonable faith that he'll do the right thing.
Okay. And so clearly they've been tightening their policy with regards to the policy rate. I don't know that there's much to say there. I guess the question is what's ahead here, right? And they got an inflation problem and they got a stagnation problem. So what do they decide to do? Nothing, or do they tighten because of inflation?
I think the BOJ is on hold until further notice. I think what you're seeing in the global financial system, I think the BOJ is just panic stricken at this point to continue tightening. So odds are, I think the BOJ is on hold until further notice.
Yeah, because you never know what's it's like a box of chocolates. You never know what you're going to get, right? So,
And the Fed too. The Fed too. I think there's a big question mark about what Governor
yeah,
Powell does. He's
yeah,
got his own challenges in Washington, and something about Asia that's always interesting is in Asian capitals around the region, they tend to care more about what the Fed does than their own central banks. Like in the Philippines and Indonesia, they care far more about what happens in Washington than at their
sure.
own central banks. And
Yeah.
so I think Japan is also in many ways sitting around wondering what might Powell do.
Okay. So figure four just confirms that inflation's running about twice as hot as their target.
Right.
Figure five, we've got the bank reserve balances. Is just another view of this monetary QE that started in 2013. And you said that aggressive QT, and I was going to say aggressive is like beauty in the eyes of the beholder. Doesn't look particularly aggressive. This doesn't look that aggressive, but I guess everything's relative. When you've been buying a lot of bonds and suddenly you're selling a couple of billion here and there, that's a change.
But for
Uh,
an economy that's been doing quantitative easing for basically for more than 20 years,
yeah,
um,
it's a
any
shock.
any QT is a shock. And I think, as I mentioned in the morning briefing today, a big concern in Japan is regional banks, right? You
Yeah.
have regional banks which are heavy with Japanese government bonds because they're not lending a lot. So there is this kind of Silicon Valley bank risk that the BOJ worries about as well, and that they've been busily stress testing these 100 regional banks to see, where the cracks lie. But that's another reason why I think the BOJ, until further notice, is probably on hold for a bit.
Any thoughts on the yen here? Looks like, technically speaking, it's trying to make a bottom of sorts. I guess if BOJ does nothing and the Fed does nothing, it's not going to be an interest rate issue, a relative interest
Well,
rate issue.
yeah, I mean, I think the yen is probably in a fairly tight range at the moment. It's personal for me because I'm often paid in yen. So
Yeah.
anytime I travel to the U.S. or Europe, it can be a bit of a shock. What's interesting is Japan's experiencing this complete tourism boom at the moment. Tourists everywhere. I'm going to Kyoto next week actually later this week for a couple of days, and there'll be millions of tourists there because Japan is suddenly considered cheap, which
Yeah.
for those of us who live here and look at Japanese prices, we don't think it's very cheap, but from an exchange rate standpoint, it can indeed look very affordable to foreigners. But the yen, the yen's in a fairly tight range at this point. I keep on hearing about forecasts of the yen going back to 150, the yen going to 140. Take your pick.
Okay. Let's do a couple of cues. Uh, Cactus, what are William's thoughts on the uh, Ministry of Finance announcement overnight to look to cut long end auction sizes, which caused a big rally in 30-year JGBs? Is the overnight move a decisive turn against bond vigilantes in 30-year JGBs? Also, when is the uh, earliest you see the BOJ hiking policy rates again? Just to jump in for 1 second, Cactus, I mean, this is deja vu all over again. It's exactly what Janet Yellen did in November 1st, 2023. She told the bond vigilantes, "You don't like my bonds, you don't like my notes. I'll just do more in bills and less in notes and bonds." And so it seems like that's what the MOF did, and it looked like it worked over here. Looks like it's working over in your neighborhood.
Well, you beat me to my answer. That's exactly what's happening. I think, like I said before, that the Japanese officials are very good in the crisis, and I think in the last 24 hours, you have seen them signal to the market that we can play a bit with the maturity spectrum, but also they're saying to the market that supply could become less of
Yeah.
a problem for the market, and they probably will be throttling back on supply, certainly for the ultra long dated securities, and they will focus more on the medium part of the curve as opposed to 20-year and 40-year
Yeah.
debt. And so that certainly is the MOF letting the markets know that
So it's no
chill
wonder
out.
that the U.S. stock market is doing so well. We got consumer confidence better than expected. We got the Ministry of Finance saying they'll issue fewer bonds, and then we got Trump going from a frustrated statement on Friday about the EU to suddenly, I had a wonderful call with the head of the EU and everything's just hunky dory. The Cactus also asked, when is the earliest you see the BOJ hiking policy rates again? Now that's a good one.
Well, I hear very good arguments for the BOJ moving one more time in July. I find that a bit hard to believe, partly because of the turmoil you're seeing in the global economy, partly because Japan is skirting recession, but also because there's an election coming up in July. And just like the Fed, the BOJ doesn't like to be seen to interfere in any way in the election process. I would not be surprised. I could, be very wrong about this, and I'm sure Ed, you'll remind me in the months ahead. But I would not be surprised if the BOJ was on hold for the rest of the year.
Yeah.
I think in many ways the headwinds are building, and even though Donald Trump is throttling back on tariffs, we hope the 25% tariffs on autos are a real game changer for Japan. Japan's also beginning trading. Well, they're in the midst of trade negotiations with the Trump administration. They're still worried about their own 24% reciprocal tariffs, and also their tariffs on steel and aluminum. So in many ways, you can argue that these tariffs so far, even though they're come down a bit, they're affecting Japan more than China. And so I would think the BOJ could be on hold for the rest of the year, but I could feel very stupid in a couple of months when they tighten.
One of our accounts is named William, and William asks, does William expect Nissan to throw in the towel? Speaking of autos.
Yeah, I mean, Nissan, 20,000 layoffs. I mean, certainly this is a very big management problem for Renault, right? I mean, it was very interesting earlier in the year to see Nissan and Honda in talks. I can't say I ever took that very seriously because these very proud Japanese brands are not exactly keen on the idea of joining forces. But Nissan is in a very, very bad way. Absolutely. And Nissan also, Nissan has a decent offering of EVs, but they're not selling very well overseas. And I mean, Nissan throwing in the towel, I would find that hard to believe. But I think there might have to be some, alliance with another Japanese automaker at some point.
We'll take one last question here. We had a good question about foreign exchange. I think we answered it. Lee asks about China. He says that the Wall Street Journal reported this morning that Chinese food delivery service Meituan reported record earnings recently at $1.4 billion for the first 3 months of the year. And he's wondering if that's an indication that consumers are still spending, or are they just hunkering down and not going out?
I would say it's more the latter. One of the big problems that China is having is that they came into this trade war with weak retail spending, and the government's been very, very slow about building bigger social safety nets to get Chinese to save less and spend more. That's a work in progress. And when you look at just the headlines for China going forward, and also the fact that youth unemployment is near record highs, the economy is slowing. There's a lot of talk about deflation. And so I would say the problem in China is really the opposite at the moment. It's the lack of consumption. And it's not, I mean, as Ed points out from time to time, Americans, they are basically spending their job prospects, right? When they have a job and they believe that they'll have a paycheck coming and they'll spend money. I think the Chinese are looking at a very different scenario in the year ahead. So it's probably the opposite problem.
Yeah, I was just concluding. My conclusion here is that Melissa Tagg is writing a piece today for tomorrow on Europe and Euro, and maybe it's not as exciting an economic outlook. And then that raises the question: is Euro ready to be the number one reserve currency? And we're not convinced of that. And then, based on our conversation here about Japan and what you've written about China. I'm not crazy about the term American exceptionalism, but there's still something to be said for that notion that there are some things that make America stand out, even on a short-term basis. William, great to have you on board. Thanks everybody for tuning in, and we'll see you again next week. All the best, everybody.